Hey everyone, welcome back to Corporate Dakota. Today we are diving into DriveItAway Holdings' latest quarterly filing, and let me tell you, it is a wild ride. Buckle up, because it looks like they're either on the verge of a breakthrough or a breakdown. Scroll Washington DC CADD 2549 Scroll DriveItAway. Ticker symbol N star, because they don't have one listed on this filing, is trying to change how people buy cars, especially electric ones. They aim to do this with a pay-as-you-go subscription that eventually leads to ownership. This report covers their performance through the end of last year. These filings are important because they give us a clear view into a company's financial health and future prospects. So let's find out what's happening at DriveItAway. First, let's take a look at their balance sheet, which shows what the company owns and owes. They didn't have a lot of cash on hand, roughly $70,000. Accounts receivable, money owed to them, was about $2,000. Not big numbers. Fixed assets, which includes things like vehicles, comes in at about $876,000. Now for the other side, what they owe. Accounts payable and accrued liabilities is roughly $1.2 million. They also have about $1.5 million in convertible notes, which is debt that can turn into stock. Then there's something called a derivative liability, which is a fancy financial thing. That is roughly $472,000. Their SBA loan from the government is just over $113,000. Overall, they have total liabilities of about $4.5 million, but a stockholders deficit of over $3.4 million. This means they owe way more than they own. Let's switch gears and check out the income statement, which tells us how well they did over the last 3 months of the year compared to the same period of the prior year. Their revenues were $1,041,946. Cost of revenue was $143, leaving them with $55, leaving them with a gross profit of about $98,000. But the operating expenses, things like salaries and software development, ate into profits with $224,303. This leads to an operating loss of around $125,000. Here's where things get interesting. They had other income of over $582,000. This meant they actually ended up with a net income of around $456,000. Sounds great, right? But when you divide that by the number of shares, it equals a gain of 0 per share for basic and diluted calculations. So essentially zero. Next, let's look at the cash flow statement, which shows how much cash they actually have coming in and going out. From their regular business operations, they used about $55,000. Investing, which is mostly buying vehicles, cost them another $137,000, but they raised about $128,000 through financing, like selling notes and warrants. Overall, this gave them a net increase in cash of roughly $35,000, ending the quarter with about $69,000 in cash. Let's briefly touch upon the equity side, which tells us how many shares are out there. During the last 3 months of last year, they sold 250,000 shares of common stock for $5,000. That brought the total shares outstanding to over 113 million. Okay, time for the fine print. Let's get into what the company says about its future. DriveItAway says that to keep going, they need more money. Their plan, sell more stock, get loans, and hope their big stockholders keep them afloat. And this is a big but, they can't promise any of that will work. Scroll, there is no cab assurance that the company will be able to obtain sufficient additional funds. Scroll, plural. There is no guarantee, according to the filing, that they will get the money they need or that they will become profitable. They also talk about how they value some of the more complex stuff on their balance sheet, like their derivative liability. They use something called the Black-Scholes model. They owe some money to their executives and related entities. As of the end of last year, they owed related parties about $25,000. They also talk about their fixed and intangible assets. Capital vehicle costs come in at over $1 million, but thanks to depreciation, the wear and tear on those vehicles, that comes down to around $876,000. Website development cost about $16,000 and were only valued at roughly $5,000 after depreciation. Let's dive into the debt situation. They have an SBA loan, a government loan with a balance of about $116,000. They have quite a few convertible notes payable. And as mentioned before, they have what are called derivative liabilities. Unfortunately, according to the report, there are material weaknesses in their financial reporting. They don't have enough checks and balances to ensure accuracy and prevent errors. Finally, it seems they don't have any legal issues at the moment. So what's the big picture here? DriveItAway is definitely in a tricky spot. Their operations aren't yet bringing in enough cash and they are relying on outside funding to stay afloat. However, they have some very serious weaknesses in their accounting and internal controls. So this is certainly concerning. While they had a profitable quarter, that was mostly due to some accounting adjustments, not a booming business. Despite the company's intention to create some sort of disruptive approach, it remains to be seen if they can actually pull it off. To me, it's a great idea at the highest level and there might be something there. However, at the moment, I am skeptical, with the report mentioning how little money they have and relying on money to survive. If it continues, it can raise some serious red flags. Thanks for watching. If you found this breakdown helpful, please give us a like, drop a comment and subscribe for more corporate deep dives.